Thank you for joining us. I think this session is broadly about the building blocks of a successful IPO. Maybe I think the public markets are a source of pain over the last month. I hope you guys haven't lost too much money. But anyways, I guess the first question I would like to start with is perhaps a bit macro before we get into the individual areas of expertise for distinguished panelists. India historically hasn't seen too many IPOs, right? And so before we kind of get into that, there's a bunch of commonalities that are common across IPOs, whether they're EdTech or whether they're in consumer tech or whether they're in fintech, that would be relevant for any company looking to list. What are some of these commonalities and strategic aspects that we should look at? Maybe it's timing, maybe it's something else. Should we start off with you, Shubham? And this is a question for all the panelists.
Thanks, Shram. Good afternoon, everyone. I'm a practicing investment banker representing Kotak Investment Banking, so hopefully, we'll try to bring some perspectives on that question. I think the IPO is a once-in-a-lifetime activity for a corporate, right? So while founders may found different companies over the course of their lives, for a corporate entity, IPO is a one-time activity. And clearly, it has to be treated as possibly one of the most important life events in the life of that corporate, right? And what do we sort of need to keep in mind for that is, one, I think, size, maturity, and the ability to act and behave like a public company, working for the betterment of minority shareholders, public shareholders, not just the founders or private shareholders, is super important. And often what we see is the best companies that we have had the opportunity of bringing public have started to behave and act like public companies long before they were actually listed. And therefore, timing is super important. Ensuring that the maturity, both in internal and external processes exist, is super important. And there has to be a reason that in terms of why the IPO is happening. Is it basically to give exit to private equity investors, early investors, angels, VCs? Is it to actually raise fresh capital for the company's growth requirements? Or is it for certain other purposes with regard to employee compensation or acquiring currency for acquisition of other companies and what have you, right? So those are sort of two things that we think are extremely important to bear in mind before a company even prepares to undertake their listing journey.
Hetu?
So I think when we look at companies which have recently IPO'd, I think one of the stark sort of patterns that we see is that companies seem to think IPO is the end game. Actually, it's not the end game. Your journey becomes far more difficult after the IPO. And I think there's a very distinct change in behavior which needs to happen pre-IPO vis-a-vis post-IPO, because public market investors have different expectations than private market investors. A couple of years ago, we did an assessment of 50 IPO companies vis-a-vis 50 listed companies, well-established Sensex stocks, right? And you look at the quality of governance when you assess them. We have an entire scorecard model that we use, and you look at their quality of governance. You find that companies which have been listed for a while, which have a long set of investors, tend to have better and stronger governance practices. I think when companies get into IPO, prior to IPO, they need to, as Shubham said, they need to behave like their public market already listed a couple of years prior. And to that extent, they need to have a stronger board, they need to have processes, systems, all of that, which get them IPO ready. I think in a lot of instances, we see companies which are happy about being IPO'd, but then they don't really understand how to handle the stakeholders once you get IPO'd, and more importantly, the regulator. Right? You have a new regulator that you have to deal with, and the way you deal with regulators it needs a certain bit of experience and training. I think some of these new stakeholders which come in post-IPO, they need to be handled with, as Shubham said, a lot more maturity than what you would see typically of a pre-IPO company with, let's say, private equity and a founder which is really running the space.
Richa?
Yeah, hi, thank you. So yeah, I think one of the points Shubham and Hetal already covered is, just having a strong corporate governance right from the beginning, right? So when they say you behave like you're a public company, we're saying that you have strong corporate governance. Some companies are moving towards it, like now when we see some companies, for example, will already have an independent director on the board, whereas that's a listed company or to be listed company requirement. But just having a strong foothold on their corporate governance, ensuring that data is clean, documents are clear, that to my mind is actually one of the more important items that I would think for a company to go IPO or get ready for an IPO. The other point which I think is more relevant from a tech and therefore an edtech company is, promoter identification. What happens in these companies is a lot of benefits that accrue to the founder is by way of giving them ESOPs. Now, as a promoter, you can't receive ESOPs. So, and therefore, if you remember for Paytm and a couple of other companies, they wanted to get identified as the founder and not the promoter, and then term them as a professionally managed company. That is an important point that, the companies need to assess, right? Because if you've given yourself ESOPs and you're just a founder, SEBI has a very set regulation on who a promoter is going to be. So you need to you need to understand what the requirement is if your eventual plan is to do an IPO, and then accordingly ascertain which bucket you want to fall into and do your benefit accrual in that fashion right from the beginning. So you don't just decide that, okay, today I'm going to do an IPO and realize, okay, now I can't have these ESOPs anymore because I'll be identified as a promoter for the purposes of the IPO. These, according to me, are two main. There are other minor points. For example, you spoke about valuation. We've seen a lot of tech companies have this valuation issue. Some companies actually having that effect on the entire stock market because of getting overvalued. So keeping that in mind, and maybe one more would be just because you have a lot of investors coming into the company because of the sector or the type of the company it is, which is tech or edtech. Just aligning all of that, their shareholding, whether they may or may not be identified as a promoter. So broadly, I think these 4 or 5 items, to my mind, would be long lead items that people should start thinking about much in advance when they decide that eventually they want to do an IPO.
Thank you, guys. I just want to switch the discussion over to history. I think historically we haven't had too many education or edtech IPOs. Now, yes, I would say in the last 3 or 4 years, it's historically been a function of some of the broader issues that we're seeing in the industry on corporate governance and other issues. But even before that, there really hasn't been too much. I guess first principles basis, why is that? And what do we need to start just building up momentum and trust in the pipeline so that more companies start going public? Starting with you, Shubham, maybe.
Very pertinent question for this audience and this summit, Shreyam. So thanks for bringing that up. It's, and just to sort of further add to what Shyam has said, it's a bit sad that there are very few scaled businesses that have actually managed to go public in the IPO markets. And a lot of it is not for lack of trying, but for lack of the right set of credentials, the right business models, and possibly misplaced incentives on why listing, And again, a great business is a great business, whether it's private or it's public. If anything, the bar is even higher for going listed or going for IPO for a great business, right? I think there are 2, 3 reasons I kind of see, if it kind of resonates with you. One is the level of fragmentation that we see in the education industry and business, if we can call it an industry, is insane. And there is this Herfindahl-Hirschman index, HHI quotient. If you were to apply the HHI quotient and look at the level of fragmentation in education in India, you will find that it is super much more fragmented than almost every other formal industry out there of any kind, both products and services companies. And that, to my mind, is a starting point of the problem, that if you look at a 200 billion odd industry, just without going into nitty-gritties, right, in terms of size of the education opportunity in India, the largest businesses are barely scraping through to $1 billion, right? So that's about 0.5% market share for the leader at best in a 200 billion industry. You don't see that in many other industries, hardly any that comes to mind. So that's the problem number one to my mind. Problem number two is a lot of businesses have gotten set up because there are, education and EdTech drove a lot of investor interest, especially in the post-startup era and the era funded by venture capital and private equity. And they were in the game of valuation rather than the game of business. I think businesses have to be set up for consumers, businesses, and for the sake of business, right? And a lot of technology businesses have added education as an appendage because it looked cool to get into that sort of a universe or business, as opposed to defining it as the business of education, massively leveraged or enabled by tech. So I think those are two real issues that we have seen when we have come across a lot of businesses that have therefore managed to found it very hard to scale beyond the 300-400 crore number. Without giving names, we see so many businesses that are reaching a top line of 300 crore, 400, 500 crore, and then there is just this glass ceiling which prevents them from getting to $1 billion. There are very few which are getting beyond a 500 crore and getting to $1 billion. And I think all of us collectively should really sit down and ask ourselves as to why that is. We don't see that kind of a invisible glass ceiling in many other industries.
I think very relevant, Shubham. Hetal?
Look, I mean, I'm very excited, honestly, with the kind of work or what's happening in the EdTech sector, essentially from what I've understood from this morning. But to be fair, from a public markets perspective, EdTech industry has seen more failures than successes. And as a public market investor, I would actually think twice, right, whether it's an industry that we really want to venture into, given that the failures have been spectacular in terms of size. And this is not just recent, right? You'd see it from a couple of years ago also. You've seen listed companies in the EdTech space also fail. So I think for more companies to, IPO in the EdTech space, yes, one is scale and size, but the other simply is to see a success story which matters. I don't think the sector has seen a very meaningful success story in the listed space. We can ask that question why, but I think from a public markets perspective, that's a question that a lot of investors will really want to be, will be asking, and therefore be a little bit more wary about EdTech sort of IPOs.
Risha?
Yeah, I agree totally, because I think one, of course, is other reasons what we discussed, but also I think just technology itself, the tech sector itself is currently new as compared to other sectors, right? Now we add another a subcategory to it, which itself has not seen, the education sector itself has not seen too many IPOs. So first of all, merging these two sectors therefore has seen a slower sort of growth in terms of an IPO. However, I think the AI and this whole spin that has come about, I think that is going to change the whole game for the EdTech sector. I'm very positive about it. Because now every industry, keep aside just the EdTech, every industry will need an AI-driven support system to just sort of move further. And I think that, to my mind, it looks positive that this is a sector that's going to grow from now on.
So I'm going to, I guess, switch over tracks from, I would say, macro questions to micro questions for each of the panelists. So Shubham, maybe this question is for you. Look, I think we're in an exciting time of EdTech where, after a long spate of pain, there's a bunch of exciting companies that are likely to go public earlier than not. And you've been deeply involved with some of them. Basis just your conversations with, investors on the ground, public investors, market timings, what are some of the specific factors that companies have to be very, very careful of, I would say, from the day-to-day of a investment banking perspective? Shubham.
Clearly, we are quite privileged and fortunate to have a couple of very important marquee leaders in their respective verticals start to think about their IPOs, although may not be immediate, but start to think about their IPOs over the foreseeable future without really putting a timeline. I think there are few common attributes that we see in those, right? One, they're actually very clear market leaders, without a grain of doubt. Within the verticals that they address, there is a very clear moat in terms of their business model offering, technology enablement, AI readiness, and so on and so forth. And finally, you know, there is a big gap between where they are versus number two within their respective verticals in terms of how they are poised and what kind of incremental market shares they're taking, what kind of incremental margins they're driving. And there is a very clear desire to build, in those 2-3 cases, multi-generational businesses that actually will stand the test of public scrutiny over decades and not just months or years. I think those are really the defining characteristics that we are actually seeing in 2-3 businesses which are starting to think on those lines, which is really heartening, right? So while there is a lot of sort of negative out there, there's a lot of missed chances, heartbreaks, failed opportunities to make money for investors, in certain cases private and certainly public. I think the pall of gloom is kind of getting lifted, and we really now need as an industry to make sure that whoever is wanting to test the public markets are the best qualified champions of change, right? Which will drive the right set of narrative and drive a growth and success story, even in the listed markets for businesses, right? I mean, just give the example of Zomato, which, you know, kick-started the whole startup IPO journey, right? And they have obviously had their own share of learnings, experiences, growth, accumulation, organic, inorganic. They've gone through a lot. And the real credit of basically, in many ways, opening up the public IPO market story for new age tech startups, that are venture funded, etc., goes to Zomato, Nykaa, some of the early folks, which have done it right, particularly Zomato. And look at how Swiggy has obviously benefited 4 years out massively from how Zomato did, you know, in the foods delivery, food services space. And that clearly has set a very strong foundation for businesses in and around that space, and also quick commerce going forward, to really test the public markets, right? So we need the Zomato equivalents for education and EdTech to give the grounding and the foundational base for size, quality, market leadership, governance, unit economics, focus on profitability within a desirable time frame, a right level of, you know, focus on minority investors. And those are the ingredients which will hold folks good, companies and their investors backing them good in the longer term, where these become multi-generational businesses and go on to become the likes of Infosys or Bharti Airtel or HDFC Bank or Kotak Bank, and so on and so forth.
Makes sense. And just quick follow-up, Shubham. I would say, you know, given there is a dearth of edtech companies, you know, folks might be tempted to look globally. Are global education or edtech companies relevant to Indian companies that are looking to list in the next, say, couple of years? And given that there aren't really too many comps, what are you guiding founders in terms of advice towards what kind of companies they should be looking at as peers or examples to be? What is the comp universe of an edtech company currently in India?
Great question. I think we kind of deal with that question on a daily basis when we have taken on these mandates as Kotak. It kind of cuts both ways, Shriyam. There are some great education edtech businesses. Duolingo comes in mind in particular, which is clear global leader, great unit economics, great model, right? And relevant globally, right? You can sort of, it has gone on to do wonders in many, many different countries outside of its home base. And in the case of sort of tech, again, I'll go back to the Zomato example, right? So one, this whole universe of VC-funded, new age, tech-enabled startups. There was no clear, when the regulator asked us as the left lead for Zomato, as to what the precedent was or what is the peer set was and how do we do the basis for offer price and valuation discovery. Right? It was really learning by doing. And there was a lot of iteration and conversation and engagement with the regulator on one hand and with the issuer and all the shareholders of Zomato on the other. And we managed to find a level setting where we managed to basically find a common ground, right? In many other businesses, you have strong global examples, like Duolingo in the case of B2C EdTechs, or strong education businesses clearly is an example. But in certain cases, you may even go beyond education and look at other successful technology leveraged, enabled consumer businesses which have got certain characteristics, Zomato being a case in point, and now Swiggy and many others, right? So clearly, it is no one-size-fits-all answer. One of the things that has happened is the regulatory bar and the regulator, SEBI in particular in this case, and also NSE, BSE by extension, the regulatory bar for quality, size, affirmations, liability documents, disclosures, both prior to IPO at DRHP and post-IPO on listing, has gone up at least 10x in the last 3 years. And if there is no appreciation or lack of appreciation for that reality, then there is a real problem with issuers and shareholders of those companies seeking listing. That is something that we would really encourage people to take stock of, and therefore address and assess those realities very differently from how people approached IPO 5 years or 3 years back. There's a lot has changed.
I'd like to add something to that. So, this is a very interesting question, and, I know where you're coming from. What is happening is when you are trying to compare yourself to a peer, and especially for an EdTech or new tech companies, like you rightly said, there aren't too many competitors. Or the other thing that's happening is, which is very interesting, is that there will be a company that will have 5 verticals. I'm an issuer and I'm one of the verticals of that company. What I am doing now currently is that I am comparing myself to this company which has 5 different verticals, and I am saying he's my competitor. His revenue is X, my revenue is X minus 5. So I'm telling the market that there is a possibility of 5 times growth of my revenue. There is market, and therefore you invest in me, in simple layman's term. Whereas that is absolutely incorrect, sort of to portray it like that, right? Because you can't compare yourself to a company which has 5 different verticals. The revenue are for 5 different verticals that you're receiving. That comparison is causing a lot of havoc, and which is why the regulator is getting a little bit upset, for the lack of a better word. But there is no other option when you don't have a comparative peer. What do? You have told me compare yourself to your peers, but there are no peers in the market currently. So these are some of the nuanced issues that we are facing in every single tech, EdTech, technology sector more specifically, because that's a newer sector.
Thank you, Shubham. Thank you, Richa. Ethel, you spent a bunch of time dealing with the C word in EdTech, and the C word is corporate governance. Get your heads out of the gutter, guys. We have a journey of founders, first-time founders that obviously have rigor due to their private investors and the systems that they built in. But the public markets are a whole different level of rigor. What advice would you have for some of these founders, making this, I would say, journey where everything just has to be ramped up within the company? The 2 or 3 things that you'd guide them to do before the IPO to make them set up for a very, very, I would say, value accretive public listing, because most of value addition over time occurs after listing than before listing.
So I think first and foremost, founders need to ask themselves, why does the company need to get listed? I think if it is to what value does the company gain from the listing? If it is to give a set of investors an exit, or it's a vanity sort of project, then that's a whole different argument vis-a-vis actually saying that the company needs capital for growth or for expansion, and in the longer term interest of raising or correcting the capital structure. I think second, I would say the founder, once you get listed, right, the founder and the company are 2 separate identities. They are not the same. And therefore, the long-term interest of the company and the long-term interest of the founder are also not the same. There are a larger set of stakeholders which come into play, and their interests also need to be managed. The fact is, if you are an unlisted company, you are judged, or at least by a small set of shareholders who are actually invested in the company and helping it grow. When you're in the public market space, you're judged all the time for absolutely everything, whether you raise money on the debt side or you raise money on the equity side, all of it comes with governance and all of it comes with challenges. So therefore, there is a certain degree of market expectation which comes in, which one has to meet, and therefore there is a certain degree of maturity with which it needs to be met. We've seen enough number of founders who react to things rather than really respond to it. You can't be, sort of trigger happy, respond to everything on Twitter. That's no longer the way the market, a listed company will really work. So I think some of these things need to be put into practice well before you get listed. Having a strong board with a very strong set of independent directors is a starting point of developing your governance structures. Having systems and processes in place which drive decision making is the other piece which is also very important in terms of ensuring that there is an operating mechanism which is stable, right? Markets like predictable behavior. You can't sort of start giving them surprises every drop of the way. So therefore, there has to be a practice of good communication, delivering news. If it's bad news, deliver it faster than the good news. But practice of proper communication, consistent communication, and predictability of behavior. All of these are things which promoters and founders need to be really aware of before they even start getting listed, and start beginning to practice all of this before you get listed, rather than trying to get into a coping mechanism after you get listed. I think that's how I would look at it.
Thanks, Etul. Richa, I think as a company goes public, obviously there's a bunch of legal considerations that I would say hygiene, right? I mean, the existing private SHA completely dissolves. There's new incorporation articles, etc. But education, I would say, has a bunch of complexities. For example, the structuring of school as trusts, the NAP, etc. Are there 3 or 4 particular nuances for an education or EdTech company listing, at least on the legal side, that they should be fully aware of?
So, I'd like to, since you brought up SHA, I'll maybe take that up first. So one of the important considerations and awareness that the issuers must have, and especially because it is EdTech, is you generally have a lot of investors, right? So there will be a number of rights that you would have given to all of these investors. Those rights necessarily have to fall away at listing. The reason is because you've been an existing shareholder, we are bringing in new shareholders, so why should different people and different shareholders come in at different level when you're getting listed? However, SEBI acknowledges, okay, you are a private equity fund, you know how to run the business, you're aware of that, therefore they are allowed director nomination right, and that's about it. Apart from that, the other point is maybe, what we discussed on the peer comparison, because that decides your offer price. When you compare yourself to peer, it's one of the metrics to finalize your offer price. So it's very important to see what KPIs, or for a lack of a better, just to use it in a layman's term, what line items from your financials you're sharing with your investors, because you will be required to use that for the finalization of your IPO price. Now, generally and historically, you end up sharing a lot more with your private investor than you would in an IPO. And if you share, then your IPO valuation will come down. And therefore, it's important to have that cleaned up right from the beginning, what you're sharing, what you're not sharing with your investors, and then link it to your IPO price. These are 2 of the main considerations. See, technically, from an EdTech perspective, there isn't really specifically that comes to my mind right now. However, from a trust structure perspective, while education is one sector where it is a trust structure, there are, so for example, mutual funds, or say a mutual fund. There also they have a similar trust structure, or say a fund is planning an IPO. So trust structures, not necessarily education, but trust structures have been tested in the past, and specifically there aren't really any specific issues from an IPO perspective. The issues are generally common with the tech sector, with the general tech sector IPO, and it's not unheard of.
Yeah, sure.
May I add a couple of perspectives to already what Richa has sort of thrown light on? I think there are 3 or 4 points I'd like to add to what she has already stated. Number one is, clearly from our perspective, when we talk about the secondary public market investors, to us, it looks like the bar is a little bit higher for regulated education businesses like K-12 or university and higher education, as opposed to the unregulated or less regulated segments like test prep or pre-K, or vocational or professional continuing education and so on and so forth. And part of the reason is because it has never been tested with regard to the regulated businesses. And it is more the fear of the unknown than necessarily the regulator saying, oh, I'm not going to allow you to basically do a regulated business IPO. It's just that both the regulator and the public market shareholders have never seen a regulated business come through of size and scale, which will allow this fear to basically get dissipated. So, but from an investor perspective, clearly there is a lot more ask with regard to disclosures, arm's length, transfer pricing issues, how money moves between the trust and the service co. All those issues are very, very central and need to be addressed in great degree of granularity, both with the regulator and the investors. So that's with regard to the trust and regulated businesses. I just wanted to kind of add the investor's perspective and the regulator's perspective in addition to what she said. The other thing I would say is clearly, there is also, in addition to other things that the regulators ask is, and what IC did today is versus 5 years back, the use of proceeds for a primary raise-led IPO. The bar has gone up a lot for what the justification for the primary raise is. And clearly, if I were to put a multiple in terms of what the ask was in regard to the backups, the diligence, the supporting evidence, you can't just go and say, oh, I'm going to build an AI model of my own for my education business, and therefore I need 500 crores. What AI model? Why do you need to build it in-house? Are you building LLM? Are you building SLM? Are you taking on OpenAI and using it for your own purposes with some improvements, or are you sort of building it ground up? It actually needs now third-party validation to actually go and validate from third-party experts with what AI model investment is, what cloud investment is, why data center you need to build, why a building needs to be built, and so on and so forth, which was never the case 3-4 years back. So just apprising everyone here that the bar has gone up a lot, and I really think that it is actually for the betterment of the markets, and both issuers and investors need to really assess and apprise themselves of this new reality of this higher bar and prepare longer, better, and maybe, the tongue-in-cheek comment is with the right set of advisor in the tent for longer than prior.
Thank you, Shubham. I think we're out of time. Thank you to our panelists for your opinions and perspectives. I will just conclude by saying that perhaps in the last half decade, we are probably in the most exciting time for education and EdTech than ever before, with a bunch of listings in the horizon over the next 2-3 years. I think there is much more hope and much more room for optimism than not. Thank you so much.